What's up, guys? This is Shane Schofield from Schofield Trading, and we're here to give you a market update. Just a quick disclaimer for you guys to look at. Just pause it and have a quick read through. Just always make sure that your risks are limited. About myself, I'm Shane Schofield. I'm the founder of Schofield Trading. I trade US equities, and I'm a technical trend trader. I like to get into trends. Also a public speaker. I manage a private fund, and I started off spread betting from home, like most people would be doing, and turned a 4-figure account into 6 figures in 18 months. The ebook's available on our website, which is at ScofieldTrading.com, and it's just basically an ebook of the trade tickets and exactly how I did it and stuff.
Hey guys, my name is Ty Vinnick. I'm with the Ace of Swords hedge fund based in California, US. So on top of being a managing member in the fund, I specialize in options trading, futures trading on different market indices, different commodities. I have more experience with professional money-making strategies such as different types of option spreads, calendar spreads, etc. I'm more of a market timer than a technical trader, although I am also a technical and statistical trader, and I try to catch turning points in the market with good risk-reward versus the bulk of trends.
Okay, guys, so this is the chart of the Dow Jones Industrial Average, and it's a daily chart. And looking on the daily, we are in this wedge pattern, and I personally think that even though October can be a very, very weak month for stocks, I think that the chart is still looking quite bullish at the moment. I like to look on IG Index at the sentiment, and still there's 86% people are short. So I would like to see this kind of reverse a bit, and maybe if we can start hitting this upper channel, maybe we could hopefully retrace. Looking on the weekly, we also have a hammer bar. So to me, that indicates that there could be strength on resistance and support for the upside. I'm expecting that to be temporary, so it could float around for a little while and make new highs, and then hopefully we could start getting a pullback. And I'm just going to be looking at the charts, and I expect this wedge pattern to be tested, and I think eventually it will be broken, and I'm hoping that it could test this 200 moving average for a potential upside rally for the end of the year. But I don't think this probably could happen until maybe mid-October or end of October. And yeah, I think the markets still look quite strong in the very, very near term, but in the medium term, I think it could be time for the pullback. But I just don't expect it to happen when everyone's expecting it to. What do you think, Tay?
The lack of corrections is just stunning, isn't it? I was looking the other day, and they were saying that I think this is the third longest period in stock market history, at least going back to 1928, without a 5% pullback.
Yeah.
It's just stunning. Like, the market just doesn't really go down anymore. Every pullback is just less than 1 or 2%, and the lack of volatility in general is I think it's breeding a lot of complacency. So we've talked a lot this year about the possibility of a new bear market and a new top that could form, and so far we say, keep following the up channels until they're broken. Don't fight the market too much before things reverse, and so far, that saved you a lot of money from being short too soon. But I mean, at some point, this just got to give, right?
That's true. But what do you think could cause the correction, though? Because obviously there's been bad news, but the news has not been bad enough for it to bring the market down. So what do you think could potentially happen for this correction to be caused?
I think that any news is good news at this point, because good news is good economic news that make the market go up, and bad news is, everybody is so used to the money printing that's going on, the QEs of the world, and the ECB, the Japanese central bank, the Fed. So if there's any negative event like Brexit or the Italian referendum or Trump's election, for example, any event that could be bad in theory, is bought because there's expectation that the central banks are going to just print more money, which is why I think, there was this big rally following Brexit because of the response of the Bank of England, for example, that, they cut interest rates and all these things. So
Mm-hmm.
It's crazy. It's like good news is good news, bad news is good news also. The cycle's got to end when people realize that the central banks don't have their back all the time. I
Yeah.
think that's what's going to cause the correction. And I can go on to that a little bit later. I think the Fed is starting to do that. So we talk about this central bank effect, and this is something that I wanted to share. In red, you're seeing the S&P 500 going all the way back to 2007. And the blue is the Federal Reserve balance sheet, or call it the, this is essentially the amount of money in circulation that they insert into the economy, how much printing is taking place, etc.
Mm-hmm.
So you can see the crisis in '08 and the recession. And here, this big jump is QE1, the first money printing. You can see that stabilized the market and put a lasting bottom. And then you can see that in 2010, the Fed stopped printing for a little bit. The end of QE1, the market fell 20%, and then they immediately started again.
Yep.
The second time they stopped in 2011, we had a 20% correction.
Mm-hmm.
And then they started printing again. So you can see the market has followed the money printing all throughout. In 2014, the Fed stopped printing, and the market did nothing until the U.S. election of 2016.
Mm-hmm.
And then when this happened, the euphoria following Trump's election and the promise of tax reform and smaller government and things like that made the market have another gasp on the upside. But you can see that broadly speaking, since the crisis, the market has pretty much followed the Fed's balance sheet.
Yeah. But this time it's not.
This time is not, and I think that has to do with the election in the U.S. and the promise of tax reform.
Mm-hmm. And what do you think about tax reform? Do you think that could potentially help the economy?
If it happens, I mean, I doubt that the government can actually make a significant tax reform go through because you have a lot of problems in the Republican Party itself, and I don't think that the Democrats are going to support it. And I think that, I mean, I looked at the plan, and I'm not sure that's the best plan possible too. I have a lot of doubts about it. So I think the market's optimism may not be, may be misfound. I'm not sure.
Yeah.
But I think that the Federal Reserve has a much more powerful force over the market than the anything else.
Yeah.
And, this could be a momentum breakout, kind of like you see in 2008 when the Fed started printing. The bottom didn't come right away. It took a little bit of time for that momentum to reverse. This could be the other way around, that the upside momentum takes a little bit of time to reverse before it comes back to the balance sheet. But why this is interesting is that in the last meeting in September, the Fed said, you know what, this huge balance sheet that we have at over $4.5 trillion, yes, that's trillion with a T, that's how much money has been printed into the economy since '09. Like, you're wondering, why is everything so expensive? Like, why is real estate so expensive? Why are stocks so expensive? Everybody's going to tell you, well, my rent's gone up, the price of coffee has gone up, everything has gone up. Why? And wages have not gone up, right? We're not making more money than we did before. Why is everything so much more expensive?
And it's borrowing that's gone up as well.
And this is why. The reason is that $4.5 trillion found their way into the economy because they were printed out of thin air and injected into the economy to reinflate asset prices after the '08 crisis. It's as clear as day just looking at this chart. Yep. So, what the Fed wants to do now, they actually said, look, we're going to start rolling this back. What does that mean? We had QE, quantitative easing. Now they're talking about QT, quantitative tightening, and no one's talking about this. That means that starting next month, in October, the Fed is going to start taking $10 billion a month off of this blue line and make them disappear into thin air. They're actually going to destroy dollars and take them out of circulation.
Wow.
So this is the first time a central bank has ever tried to do this, and it's exactly the opposite of what they've been doing for so many years, trying to inflate everything. They've actually expressed concerns that things are too expensive, that commercial real estate is too expensive, and that even stocks are overly valued. And they're trying to roll it back, and they're taking a huge gamble thinking that the economy is strong enough to be able to slowly and gradually roll it back without popping this big bubble that they've created. I don't know if it's going to work or not, but we should really be vigilant for this. So This October is going to be the first time they're going to start destroying 10 billion a month on a monthly basis. And this will increase to the point that in 2018, they're going to be destroying $50 billion per month, $600 billion a year that is going to completely disappear. So I'm taking money, just like they created money out of thin air, they're going to make it disappear back into thin air, and we're going to have less dollars in the world. If we have less dollars in the world, that kind of translates to asset prices just falling, right? Unless we have more growth.
Yeah.
So we should be watching this blue line into the future starting to drop. And based on this history that you can see, the stock market has been supported by this money printing. What do you think could potentially happen if we start seeing $50 billion a month being destroyed?
But do you think the 10 billion a month is going to make an effect on the market in the short to medium term?
That's the good question. I'm not sure it will. I think 2 billion is too little, but coming into next summer, we're already talking about 50 billion. But at the very least, I think the upside momentum is going to be stalled significantly because there's just going to be less money around to get pushed into the stock market.
Do you think any money is still held on the sidelines outside of this market? Do you think that, a lot of hedge funds and a lot of big investors are waiting for this potential pullback to then potentially buy it for a discount before we get that truly recession?
Historically, what happens is that there's always chasing going into the end of the year, which is the reason why we always have this November, December rally. And the reason is a lot of hedge funds and a lot of pension funds, they usually don't do as well as the market. So towards the end of the year, they don't have a choice but to chase everything to have better performance numbers so they can get a bigger, fatter bonus at the end of the year. That's just how finance works. So that's usually why you get that December rally. So yes, if we do get a pullback into October, early November, I would be buying it for an end of the year rally. But what we're talking about here in the grander scheme of things is that in 2018, with this quantitative tightening taking place, we could be in a totally different scenario where we're having a consistently falling market. We have a larger correction, and we could even be facing a bear market. I don't know yet. We'll see signs in the charts when we get there, but the fuel that's been driving this for so many years may be reversing, and I just want people's attention to be focused on that and to think about that and to contemplate what that means when this easy money time may be ending.
Yeah.
And that also means that borrowing rates are going to go up, right? Interest rates will go up, and interest rates are already going up. So it's harder to borrow money. It's harder to, get easy loans to buy real estate or even margin. And, that is very, 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 dangerous situation, especially when loans and outstanding loans are at an all-time high.
Yeah. And obviously you have to pay back more on your borrowing. So if you have a mortgage and you have to remortgage, then, you're potentially paying back more than you initially was when you first taken out your loan.
Yeah, this is a good website that I recommend for people who want to go to a little bit more research and due diligence on this type of stuff. Fred Economic Research, the Federal Reserve of St. Louis, they put out a lot of free information about the economy, and you can look at anything from commercial loans outstanding to total loans outstanding to total debt. For example, here if we click on debt, we can see federal debt, total public debt, debt to GDP. So let's look, for example, at the total amount of debt of the public. So this is a scary chart, right? This is the amount of debt that has, that is continuously increasing and increasing and increasing. And what we see during recessions, we don't even see debt falling. We actually see debt slowing down. It's not even going. It's not. So here in 2008. You had this slowdown in debt growth, and then the way to get out of the crisis was to dramatically inflate debt.
Yeah.
Which was made possible by cheap borrowing costs.
Yeah.
This is something interesting. We're actually seeing this line flattening out. So this is another thing that I'm watching. But there's a lot of charts like this. So, if you have some spare time and you want to do a little bit of homework, I recommend going on this site. You can spend hours on this looking at different series of data, all free from the Federal Reserve.
Yeah.
So I guess let's go back into what, out of this philosophical discussion into,
Yeah.
how can we trade this, right?
Yeah.
So this is the long-term weekly chart of the S&P. We have this firm bull market trend line in place, but we're pretty far from the trend line.
Hmm.
And I think it's similar to this event where, we rounded off and eventually tested this trend line. I think longer-term new longs that are looking to get in for a time period of, many months or up to a year or two, it's much better to be buying tests of the long-term trend line than it is to buy anywhere in between.
Yep.
And, if you're looking for a good entry point, this would be a good one. I think that the biggest sign that a new bear market started is when this line just breaks.
Yep.
I know it's long term from here. It's like 2150. We're 2500 and plus, but that would be a good sign. In the shorter run, we have this up channel in the S&P, but it's not as quick of a rise. It's not that firm of an up channel as it used, like after the election, that we had a much firmer, stronger, steep, type of trend line. Even converges with this one. So I guess if we fall below this level and eventually this level, I think it opens up the floodgates to test this area. I don't know if it will happen. I don't know if it will happen this year though, but you can see, for example, here we had a very low volatility situation also, and we had this trend line wedge. It broke. It still played around for a little bit, kind of like this. And then you had a steep down move. You had like a B wave up, and then you had another big down move to here. So maybe we have something that looks similar to that, where eventually we kind of crack through, and we have an underside type of test. And then sometime in 2018, we hit this level.
Yeah.
And then initially, of course, it will be a buy. And the question will be, will we eventually roll back up to new highs, or will it go up and fail again and start a bear market?
Yeah.
I think that will be the 2018 question. So the question is the economy strong enough to withhold this big experiment that the Fed is doing, trying to contract the balance sheet? And I just don't know the answer to that yet, but I'll definitely be looking out in 2018 to see. But in the short run, we should definitely be looking for some downside action soon. I think small caps had a huge run too lately, but it's gone over this channel, and I think this could be a fake out. I'll be watching in the next couple of weeks to see if it comes back in and retest this bottom area too, or not. But the volume that took place on this day could be, at the beginning of an upswing. You can see the volume here. That was a sign. That was a sign of a new trend coming in from the bottom. A lot of times when you get it at the top, though, it's a sign of exhaustion.
Yeah.
So let's watch and see whether or not it is exhaustion or we can continue this upswing. So as a short idea, I like this if we go back below this channel with a stop above this high and a target of the bottom of the channel. If for now it's a watch. So there's not that much to do at the moment as far as trades go. Kind of like a wait and see environment. I will be looking for shorts, not longs, if we get those conditions. And later in the year, as you said, if we do get a pullback somewhere in this level, which is, I guess it would be the 200-day moving average. Let's see what that.
Do you think that could be a potential test at the 200 for the S&P?
Yeah, absolutely. I'll be looking for that. That's a 50. So, yeah, 200-day moving average would probably be a good target for this year. You're looking a little bit below 2,400. That's nothing. That's not even, that's 5%, 5% move probably, and then we'll have end of year chasing. I don't think we'll get a very deep correction anymore. If we were talking and we were in May or June, we could have gone a much bigger correction. But now going we just have November, October and half of November to really get the damage done, because then towards November, December, all these funds are going to chase the market into year end as they normally do, just so they can get a bigger bonus, and the year will be over. So, we'll be looking for this trade. Short term down, then up, and 2018 will be a key year to see what happens.
Yeah. Yeah, I definitely agree with that.
Right. So this is statistics I made. I was looking for VIX patterns in October to help me with some option trades that I put on, which I already put on. So the last 10 years, right? 2007, the VIX goes to, let's actually, this is a daily chart, so, we can look at a weekly here. Okay, so 2007, it's beyond here, but the VIX got to 20. 2008, okay, financial crisis. Here's October. You can see the VIX goes to 60. Pretty incredible in October. 2009, the VIX goes to 30, so let's find it. 2009, you see the entire year the VIX goes down besides October. That's October.
Wow.
So in October, the VIX went from 20 to 30, 31. 2010, here's 2010. Right, so 2010, the VIX goes up in October, not by much. It goes from, 18-ish, 19-ish to 24. Okay. 2011, October, the VIX went from 31 to 45.
Oh.
So that's 2011. 2012, here's our October, VIX goes just to 20. So from 13 to 20. 2014, let's find October. So the VIX goes to about, I guess the peak was around 30.
Yeah.
Is that November? Yeah, no, that's still October. The VIX goes to 30 in October, and on October 17th. So the VIX started the month somewhere at 12, ends at 30. 2015, October, the VIX zooms up really, like, here's our October, let's see it. The VIX gets to 28.
Yeah.
2016, VIX goes from the 12 level to 23. Yeah. So what's 2017? Every single year, we've seen a large VIX spike in October. Yeah. Historically, it's the most volatile time of year, and we are getting into October with the lowest VIX reading in history for this time period. Which has never happened before. And we're at the bottom of this wedge at a 9.5 VIX. So this is how I prefer to play the downward move. I like having calls and volatility. Mm-hmm. I pay for them by selling puts on the VIX, but it's a little bit more complicated strategy. But I'm excited to see what this October brings, and hopefully then reversing the position into a long position for year end. So I'm trying to get both ends here. Yeah. That makes sense. Selling puts at the VIX at this level definitely makes sense. I don't know how you can't do that. I mean, that's just but this has been a challenging trade, because you would think that the VIX will never see a 9 handle ever, and here you see it happening. I mean, this is the lowest boundary the VIX has ever seen. I think this year we broke all-time low reading for the VIX. Yeah, I'm pretty sure we did. That day, the VIX had a low of 889. Mm-hmm. That was the lowest in history. Yeah. So we are making these hammer bars after prolonged downward move in the VIX. I think the VIX is struggling getting lower than this level. I'm not sure we'll get back to this low. So, if we can hold this level here, you're seeing the VIX is making this really long wedge pattern that is really close to cracking up. Yep. And if it does, it can unleash a monster of volatility, where at the same time the S&P may be making a wedge on the upside as well. So if we get a break here, we would definitely get a break here. And at the same time, what's interesting, the VIX is not making new lows while the S&P is making new highs. Absolutely. I was watching that. I was definitely watching that. So let's see what happens with that. That's That's going to be an interesting October. I mean, we have so many potential risks out there that the market is completely ignoring. You know, North Korea, Fed tightening, interest rate hikes, another euro crisis. I mean, there's so many different things you can pick and choose, and so far, the complacency has just been staggering.
Yeah.
So, what would it take for a big VIX spike to happen? I don't know. You know, but I know that the potential is there.
Do you think it could just be potential selling pressure that hasn't come to the market for a while, and that could cause the next correction or the next big downfall?
No, I'm sure. I mean, at some point, you know, people have learned to ignore risk altogether because they don't believe the market can go down anymore, and they've seen that nothing matters. They've seen that anything from North Korea nuclear tests to Brexit just doesn't make the market go down. So why would I sell? You know what I mean? And that is a dangerous situation because people forget all about risk, and people forget that the market can correct and they can lose a lot of money very quickly. And the risk is almost always to the downside. People have to remember that.
Yeah, definitely.
So, I mean, yes, let's see what happens here. I think that we're in an interesting situation, and you know, a lot of money can be made on both sides, and I'm excited to see what the end of the year brings and what next year brings. And I think it's going to be a killer time to make some money.
Yeah, I think there's definitely going to be some big moves and some big opportunities.
Because we've been in this low volatility with not a lot of moves and not a lot of opportunity for so long now, and volatility is obviously very, very mean reverting. And when volatility picks up, so is your opportunity to make money as traders.
Yeah, definitely.